A market indicator with a perfect 60-year record is now signaling an imminent stock market crash.
Former Fed advisor Danielle DiMartino Booth joins our expert panel to pinpoint the exact triggers for collapse.
Get the essential signals from 5 top analysts and discover why a returning normal curve is dangerous. George Gammon is back with a massive warning about what he calls the Godfather of indicators, the 3-month 10-year yield curve.
And it's for good reason. This specific indicator has been incredibly reliable, basically calling every recession since the mid-60s.
Wait, so it's got a perfect track record? Not even one miss in 60 years?
100%. When this thing flips, the clock starts ticking for the entire economy. The core of George's argument is that the yield curve is currently screaming that something in the system is broken.
Right, because normally you'd get paid more to lend money for 10 years than for 3 months. When that flips, it means the market expects a disaster.
So short-term rates being higher than long-term rates is basically the market saying, we're terrified of the next 6 months.
Exactly. It shows the Fed has pushed rates so high that it's literally choking off the liquidity the economy needs to breathe.
George makes a huge distinction here. The inversion is the warning, but the un-inversion is the actual trigger.
This is what people miss. They think as long as it's inverted, we're safe. But the crash usually happens right as the curve starts moving back towards zero.
So when things start looking like they're returning to normal, that's actually when I should be running for the exits?
Basically, it's called a bull steepener. Short-term rates crash because the Fed is panicking to save the economy. But by then, the damage is done.
History shows there's often a lag. We saw this in 2000 and 2008. The inversion happens, everyone relaxes because nothing breaks immediately, and then, boom.
It's like the calm before the storm. How long do we usually have?
It varies, but once it starts steepening back out, you're usually looking at months, not years.
And George points out that the current inversion isn't just some minor dip. It's one of the deepest we've seen in decades.
When you're this inverted, it means the pressure cooker is about to blow. You can't keep short-term rates this far above long-term yields without breaking the banking system.
So what's the endgame? George is predicting a hard landing. No soft landing in sight.
He expects the Fed to pivot and slash rates, but he warns that by the time they do that, the recession will already be in full swing.
So the rate cuts won't actually save the stock market?
Historically, the market drops another 30 or 40% after the first rate cut in these scenarios.
He's also looking at a massive liquidity crunch. When the curve uninverts, it usually coincides with a major blow-up in the credit markets.
So we're talking about a repeat of the 2008 banking crisis.
George says it could be that or something even more systemic. The indicator is basically saying the everything bubble is about to meet its pin. The main takeaway is to keep your eyes glued to that 3-month 10-year spread.
If you see it heading back towards zero, don't celebrate. That's your cue that the recession is starting.
Bottom line, George thinks this is the time to be defensive, not aggressive.
Got it. When the Godfather speaks, you probably shouldn't ignore the warning.
Exactly. Cash might be king until the dust settles.
Nick Gerli is sounding the alarm on the summer 2026 housing market, pointing to a shocking U-turn in the data.
That is right. Data from ShowingTime, which is owned by Zillow, shows that home tours are plummeting by nearly 35 to 40% compared to last year.
Wait, does that mean demand is drying up even faster than people expected?
Exactly. Fewer tours today mean fewer sales tomorrow, and Nick is already seeing the fallout in the form of massive seller losses.
The core of the issue is that the summer 2026 market is stalling before it even begins. Nick found examples of sellers taking losses between $150,000 and $200,000.
He highlighted one house in Atlanta that sold for $330,000 just 2 years ago and is now listed for only $190,000.
A 48% drop in just 2 years. That is incredible.
Nick points out that the downturn is very regional. Markets like Seattle, Silicon Valley, and Denver are seeing monthly value drops of 6 to 7%.
That annualizes to a decline of 7 to 8% per year. Meanwhile, downtown San Francisco is actually up 1.2% because of the artificial intelligence boom.
So the AI gains are highly concentrated, while other tech markets are still in a deep correction.
Affordability is the main driver here. Even existing owners who have low mortgage rates are seeing their total payments for taxes and insurance jump 40% since 2019.
For new buyers, the average monthly payment has hit $2,800, which is why 36% of people in Nick's poll said they will not pay more than $1,500 a month.
We are now at a point where the number of 6% mortgages in the system outweighs the number of sub 3% mortgages.
This shift is forcing more owners into distressed sales or short sales because they simply can no longer afford the carrying costs. Nick expects the momentum of these price drops to continue into the fall of 2026 and through 2027.
As more sellers hit the panic button and inventory grows, the deals for buyers will likely get even better over the next few months. With home tours down 40%, sellers are going to get much more desperate, especially in high-supply areas like Austin and Dallas.
So if you are looking to buy, it might pay to wait for these sellers to reach their breaking point.
Nick suggests looking at more affordable states like Alabama or Arkansas, where monthly payments are still closer to that $1,500 threshold.
He also recommends using data tools to analyze specific zip codes and make offers that are 10% or more below the listing price to protect your equity.
It sounds like the main takeaway is to stay budget conscious and use tools like the Reventure app to avoid catching a falling knife.
Exactly. Do not rely on hype. Rely on the data to find the best deals in 2026. Steve Hanke is back, and he is not talking about traditional charts today. He is warning about the big players theory.
Right. He says we are in an era where figures like Trump or Musk can move the entire market with a single announcement, often ignoring fundamentals entirely.
So it is not about supply and demand anymore, just who is shouting the loudest.
Exactly. He calls it noise trading, where the herd follows rumors rather than economic reality.
Hanke compares current United States policy to a centralized system where everything runs through political announcements.
He says this regime uncertainty is why asset prices are disconnected from reality. If this continues, he predicts an economic catastrophe.
Is there any way to avoid that? Or are we just stuck in the big player game?
He says we need to get back to fundamentals, but right now, the herd is just jumping on the bandwagon of whoever is at the control tower.
Let us look at oil. Trump wants gas at $2.50, but Hanke says that is delusional given current costs.
Yeah, Hanke's baseline for crude is $85 to $90 a barrel. He thinks the market overshot the downside after the recent Iran headlines.
And what about the rich getting richer while everyone else feels poor?
He points directly to the money supply. Billionaire wealth went from 13.7% of GDP to over 26% because the Fed goosed the money supply.
So the Fed is basically a wealth redistribution machine for the top 10%.
In Hanke's view, yes, their policies are not neutral, and the little guy is left with massive sticker shock at the pump.
Some suggest raising the minimum wage to help, but Hanke says that is the wrong move.
He argues that if you jack up wages above market equilibrium, you just price low-skilled workers out of the market entirely.
So where is oil actually heading?
Hanke expects crude to hit $85 to $90 once we have to replenish the 1.2 billion barrels borrowed from the future.
And the catastrophe he mentioned?
He says if the war drags on and the strait remains restricted, we are looking at a disaster. Trump knows it, which is why he is trying to use the Department of Justice to force prices down now.
The fix is simple in theory. The Fed needs to embrace the quantity theory of money.
That means keeping M2 growth at 5 to 6% and avoiding these wild swings.
So if they just focus on stable money growth, the economy settles down.
That is the idea. Without neutrality in the money supply, the big players will keep winning, while the average citizen falls behind.
We are looking at an economy that Danielle DiMartino Booth says is behaving very differently from what the official headlines suggest.
She has that unique perspective of being a former Dallas Fed advisor, and she is now the CEO of Chi Research.
So she is looking for the hard data that is often hidden in the revisions.
Exactly. She is focused on things like the quarterly census of employment and wages, instead of just the monthly surveys.
The core of the discussion is this K-shaped economy. We have been told the top arm is doing great, but that might be changing.
Is it the wealthy who are starting to pull back now?
That is what the data shows. Confidence among top earners is coming down more quickly than any other group, and that is a major red flag for the broader economy.
The employment numbers we see on the news are just surveys, but the hard data tells a different story.
Danielle points out that in 2025, the quarterly census showed hundreds of thousands of full-time jobs were actually lost.
So the strong labor market was essentially a statistical illusion?
In many ways, yes. Once you get to the third revision, the recessionary signals become much clearer.
We are seeing a hockey stick move in bankruptcy filings. Corporate insolvencies are up 40% year over year.
And consumer bankruptcies are starting to follow, rising about 10% recently.
Is that just the pandemic stimulus finally wearing off?
It is the piper demanding to be paid after years of forbearance and cheap credit.
A huge part of the risk is hidden in the shadows. The non-banking system now holds over 51% of global assets.
That is $258 trillion sitting in unregulated spaces like private credit and private equity.
And that is where the real instability could start.
Precisely. The lack of transparency there makes it a level 7 or 8 on the concern meter.
Looking ahead, we should expect to see some negative month-over-month prints for headline inflation.
Between the math of shelter costs and the drop in oil, the inflationary pulse is fading fast.
Will the Fed celebrate that?
They might, but it is coming because the economy is cooling significantly.
Despite market expectations of a rate hike by September, Danielle thinks that is a losing bet.
She does not see a hike happening in 2026, especially as the bankruptcy cycle picks up speed.
So the market has it wrong again?
It appears so. The higher for longer pain is already doing the work for them.
In this speculative environment, the best move is to make sure you have some chips off the table.
You can get 4.1% on a 2-year treasury right now, just to sit on cash and wait.
So, playing it safe is actually rewarding right now?
It is. There is no reason to stretch for risk in a market this heated.
As we head toward the 250th anniversary of the country, it is a time to reflect on our resilience.
But also to stay vigilant about fixing what is broken in the macroeconomy before the next cycle hits. Chris Vermeulen is back with us, and he has taken a very different stance than most of the guests we have had lately.
While everyone else says to buy the dip, Chris actually sold near the top and is sitting in cash, waiting for a specific technical level to buy back in.
So he is ignoring the macro headlines and just trading the levels on the chart.
Exactly. He is looking at price action and volatility through a lens of nearly 30 years of experience. And he thinks gold has more room to fall before the real rally starts.
Chris's core thesis is based on the 618 Fibonacci level, also known as the golden ratio.
That sounds like a deep technical concept. What does it mean for the price?
It means that after the recent sell-off, gold is likely to drop to about $3,600. He calls that the sweet spot, where the metal becomes undervalued or at fair value for long-term investors. Chris mentions he exited his gold positions just above $5,000. He is not afraid to sit on his hands and wait for the right opportunity.
Right. He says he does not want to waste time holding an asset that is moving sideways or lower for years. He would rather wait for the train to leave the station in the direction he wants before jumping on.
Even if that means buying back in at a higher price later.
Yes, because he values momentum and time over just getting the lowest price. It is all about risk management.
Another factor he is watching is the US dollar, which he predicted would break out.
The dollar chart is currently pointing to a rally up to 109. That 9% move in the dollar is going to be a major headwind for both gold and silver.
So as the dollar goes up, metals naturally take a hit.
Usually, yes. It is an inverse relationship that is playing out exactly as the technicals suggested it would back in April. Chris is also seeing signs of exhaustion in the S&P 500.
He is noticing money rotating out of the Magnificent Seven and into boring defensive sectors like utilities. It is an early warning sign that the broad market might be getting tired.
So investors are looking for safety, even while the indices are near highs?
Exactly. When big money starts flowing into utilities, it is because they are worried about a larger market correction on the horizon.
The near-term prediction is a drop to 3,600, but the long-term outlook is incredibly bullish.
Once gold finds its traction at that lower level, the next upside target is between $8,000 and $8,600.
That is more than a double from current levels. How long could that take?
He does not put a specific date on it because cycles can take time, but the technical measured move points directly to those high thousands. Silver is in a similar boat. Chris expects a sharp correction, which he calls a cleansing event, to wash out emotional traders.
He sold silver at 111 and is looking for a much lower entry. But long term, he sees silver reaching $165 to $175 an ounce.
Triple-digit silver? That would be a historic move.
It would. It usually lags gold, but then moves much faster once the momentum shifts.
With the Japanese yen hitting a 4-decade low, Chris expects the US dollar to continue its strength toward that 109 level.
He warns that the global financial system is fragile, and this dollar strength could trigger margin calls in over-leveraged positions across the commodity space. The final takeaway from Vermeulen is that trading is about following rules, not emotions.
He emphasizes having an exit plan. It is better to take a small loss and protect your wealth than to hold through a 20 or 30% drop that takes years to recover.
So keep some cash ready and watch for the relaunch signal.
Exactly. Wait for the train to leave the station in your direction before you commit your hard-earned capital. Let's start with Chris Vermeulen. His whole play is technical and patient. He sold near 5,000 and is waiting on a very specific level.
Right. He points to the 618 Fibonacci and expects gold to drop to 3,600 before the next leg up.
Hold on. So he actually sat out the rally and prefers cash until gold hits that low.
Exactly. He values momentum and risk management over trying to catch the absolute bottom.
Danielle DiMartino Booth brings the hard data view. She says the top arm of the K is stumbling.
She highlights that bankruptcy filings are up 40% year over year, and that the non-banking sector holds over 51% of global assets, which is a major vulnerability.
So the official headlines mask a lot of rot underneath? That sounds worse than the headlines make it seem.
Yes, she argues the revised hard data shows real deterioration, and that argues for taking chips off the table.
Steve Hanke's angle is different. He worries the big players in politics have turned markets into a noise machine.
He blames regime uncertainty and erratic money growth for disconnecting asset prices from fundamentals, and wants M2 growth back to 5 to 6%.
Just wait. So he's saying it's not just bad data or technicals, it's political shouting that moves prices.
Exactly. In his view, that politicization can create systemic mispricing and even larger crashes if left unchecked.
Nick Gerli turns the lens to housing, showing data is collapsing this summer and it's already hitting sellers hard.
He points to home tours down roughly 35 to 40% year over year, and examples of sellers taking $150,000 to $200,000 losses.
Whoa.
So affordability and rising carrying costs are turning markets into foreclosure and short sale territory?
Yes, and he thinks that momentum will push through the fall of 2026 into 2027, creating buyer opportunities but heavy seller pain first.
George Gammon focuses on the yield curve, the 3-month over 10-year inversion, the so-called Godfather indicator.
He stresses the inversion has a spotless long-run record, and that the real danger comes when it uninverts. That bull steepener often precedes the crash.
So it's not just the inversion. It's the un-inversion that should make me nervous.
Yes. Historically, the market often falls further once policymakers start cutting and the curve steepens back.
What ties these takes together is caution. All 5 guests are effectively saying this is not the time to be reckless.
Chris is sitting in cash. Danielle is advising chips off the table. George urges defense. Nick warns of housing losses, and Steve flags systemic mispricing.
So, despite different language, everyone basically agrees. Don't be overexposed right now.
Exactly. Whether you call it technical exhaustion, bankruptcies, politicized markets, falling housing demand, or an inverted curve, the shared reasoning is that downside risk is elevated.
Another clear overlap. Everyone points to monetary variables, rates, yields, and the dollar as the key levers.
Chris is watching the dollar toward 109. George is watching the 3-month 10-year spread. Danielle flags rate expectations and treasury yields. And Nick ties housing stress to mortgage rates.
So watching rates and the dollar isn't optional. It's the headline risk for every market piece right now.
Yes, their reasoning converges. Shifts in liquidity, short-term policy moves, or dollar strength can rapidly transmit into metals, housing, and equities.
Here is a real clash. Each guest names a different plausible trigger for the big breakdown.
Chris argues it's chart mechanics and a dollar rally toward 109 that will pressure metals and trigger margin stress. He sees technical exhaustion in equities.
Wait, so Chris thinks a strong dollar and technical sell signals set off the cascade?
Yes, but George counters that the critical event is the 3-month 10-year curve uninverting. When that happens, the liquidity squeeze hits the credit system.
Danielle pushes a different story. She says the K-shaped top and rising bankruptcies in the shadow system. Remember that $258 trillion in unregulated assets make the economy fragile from the inside.
So she thinks it's hidden debt and insolvency waves, not just yields or the dollar.
Exactly. And then Steve adds politics and regime uncertainty. Big players and erratic money growth distort prices, which can amplify any shock. And
finally, Nick argues real estate demand collapsing, showing activity down about 35 to 40% will create regionally concentrated blowups that ripple outward.
So the disagreement isn't that risk exists, it's what flips the switch first. All are plausible, and that makes timing and positioning really hard.
They also disagree on the best defensive posture. Everyone offers a different safety play.
Chris is literally in cash, waiting to buy gold at 3,600. He sold just above 5,000 and won't chase it down there.
And Danielle? She wasn't buying gold. She recommended sitting on cash, but also pointed out you can get 4.1% on a 2-year treasury.
Right. Danielle favors short duration yield and protection, whereas George says cash may be king until after the first rate cut, and that equities often fall another 30 to 40% after cuts in this pattern.
Nick is different again. He wants buyers ready to pounce on housing discounts, making offers about 10% below to protect equity.
So, one camp says lock in safe yield, another says hold cash for opportunistic entry, and another wants bargains in property. That's a lot of options.
And Steve would add the policy layer. Unless money growth is stabilized, any of those defensive choices could be undermined by politicized market moves.
That's the rundown. 5 distinct theories, 1 clear theme. This moment calls for vigilance.
If this comparison helped you cut through the noise, hit like and subscribe so you catch the next expert mashup.
Seriously, share this with a friend who thinks markets are fine. They might change their mind.
Thanks for watching. Stay curious, stay cautious, and we'll see you in the next breakdown.